Welcome to our series on bonds. Today, we're exploring one of the most fundamental investment instruments in finance, bonds. Think of bonds as a way to lend money and earn income from it. By the end of this video, you'll understand exactly how bonds work and why they might be an important part of your investment strategy. So what exactly is a bond? At its core, a bond is simply a loan agreement. When you buy a bond, you're essentially lending your money to a borrower, which could be a government or a corporation. In return for lending your money, the borrower promises to pay you regular interest payments throughout the life of the bond, and then return your original principal amount when the bond matures. It's like being the bank, but instead of the bank lending money, you're the one doing the lending. Every bond has 4 essential components you need to understand. First is the face value, which is the principal amount you're lending, typically $1,000. Second is the coupon rate, which is the interest rate the borrower pays you periodically. Third is the maturity date, the specific date when your principal will be repaid in full. And fourth is the issuer, the entity borrowing the money, whether that's a government or a company. These 4 elements define the complete structure of any bond investment. The bond process follows 3 simple steps. First, you lend money by purchasing the bond at its face value. Second, you earn interest through regular coupon payments, which might be paid annually, semi-annually, or quarterly depending on the bond terms. Third, at maturity, you get your original principal repaid in full. This predictable structure makes bonds attractive for investors seeking steady, reliable income streams. Bonds come in 3 main categories. Government bonds are issued by national governments and are considered the safest option with stable, though typically lower, returns. Corporate bonds are issued by companies and offer higher yields to compensate for the additional risk. Municipal bonds are issued by local governments and often provide tax advantages, making them particularly attractive for certain investors. Each type serves different investment goals and risk tolerances. Let's look at a concrete example to make this clearer. Imagine you purchase a bond with a face value of $1,000, a coupon rate of 5% annually, and a maturity of 10 years. Each year, you'll receive $50 in interest payments. Over the full 10 years, you'll collect $500 in total interest. Then, at the end of year 10, you'll receive your original $1,000 back. That's a total return of $1,500 from your $1,000 investment. While bonds are generally considered safer than stocks, they still carry risks. Credit risk means the issuer might default and fail to make payments. Interest rate risk occurs because when market interest rates rise, existing bond values fall. Inflation risk means your fixed interest payments might lose purchasing power over time if inflation increases. And liquidity risk refers to the potential difficulty of selling your bond before maturity if you need access to your money. Understanding these risks helps you make informed investment decisions. Despite these risks, bonds offer compelling advantages. They provide steady income through predictable interest payments, making them ideal for retirees or anyone seeking regular cash flow. They're generally lower risk compared to stocks, offering more stability during market volatility. And bonds provide excellent diversification, helping balance your portfolio by offsetting the ups and downs of stock investments. For these reasons, bonds remain a cornerstone of well-rounded investment strategies for investors at all levels.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.